Have you ever heard the phrase, debt is the root of all evil? Many people believe that avoiding debt is crucial because debt can feel like a form of slavery. When you're overwhelmed by debt, it can seem like your life is over. As you struggle to pay off your debts, they don't wait for you. They grow day by day due to interest. No one lends money for free, and there is always an interest cost. Despite this, the United States has fully embraced debt. Total US consumer debt is now nearing $15 trillion, which brings the average household debt to over $5,300. Considering the US GDP is just over $21 trillion, it shows how deeply debt is woven into the economy. This means the entire economy is built on debt to a significant extent. However, there's some good news. Not all debt is bad. This might be an unpopular opinion, but it's important to understand that while most debt is harmful, some types can be beneficial. You likely have some debts, credit card debts, a car loan, and maybe student loans. You might think it will take decades to pay these off, so how could debt ever be positive? To understand this, let's see how wealthy individuals use debt to increase their wealth. It may sound confusing. Why would anyone rich use debt? Isn't debt for people who don't have money? But in capitalism, debt is a powerful tool if you know how to use it. In this video, you'll discover how the rich use debt to get richer. So give this video a thumbs up and let's dive in. 1. Trade in debt. Most trade is based on debt. Borrowing money to start a business might sound like a terrible idea, and personally I wouldn't do it. However, for traditional businesses, using debt can be a smart move. Imagine you want to sell pens. It's a common product with steady demand. You could find a factory in China through websites like Alibaba, purchase a container of pens, and ship them to the US to sell. Here's the catch. You don't always have to pay for the products up front. Many Chinese factories will loan you their products if you build trust with them. You sell the products, pay the factory later, and borrow more products. This strategy doesn't tie up your own money, making it a powerful business tool. In the past 50 years, China has become the factory of the world, producing almost everything. Thousands of factories work non-stop to produce the goods the world needs. To make it easier to sell, many of these factories will gladly loan you their products on credit, expecting payment in the future. They won't lend to strangers, so you'll need to build trust first. But once established, this method allows businesses to operate without tying up their own funds in inventory. They essentially help factories sell their products, earning a profit by selling above the factory price. This approach frees up capital, making selling one of the greatest skills to master in business. 2. Refinancing real estate. Real estate debt is full of loopholes and is beneficial for tax purposes. Rich people often have multiple mortgages to take advantage of these deductions. Saving on taxes is essentially earning extra money. Here's a practical example. If you save $200,000, that's a lot, but not enough to buy a house outright. You can get a mortgage up to $800,000 with a 20% down payment. Suppose you buy a property for $500,000 that needs renovation. After spending $50,000 on renovations, you refinance the mortgage. Initially, the property's value was $500,000, but after renovation, it could be worth $700,000. You get a new mortgage for 80% of the new value, which is $560,000. Pay off the first mortgage, cover renovation costs, and you're left with $110,000 in profit. You've made money using debt and have a property that generates rental income, avoiding taxes due to the mortgage. This method, known as refinancing, allows property owners to pull out equity from their properties. By improving a property's value and then refinancing, you can access additional funds, which can be used for further investments or personal needs. It's a common strategy among real estate investors to build wealth and generate passive income. For instance, consider you have saved $200,000. While this is a significant amount, it might not be enough to buy a property outright. With this sum, you could secure a mortgage for up to $800,000, given the standard 20% down payment requirement. Let's say you purchase a property for $500,000, which is in a state of disrepair. You invest $50,000 in renovations to improve the property's condition and value. Initially, the property's worth was $500,000, but after renovations, its market value increases to $700,000. At this point, you can refinance your mortgage. The new mortgage would be 80% of the property's current value, which is $560,000. From this amount, you pay off the initial mortgage of $400,000 and the $50,000 spent on renovations, leaving you with a profit of $110,000. You've effectively used debt to create wealth and now have a property that can generate rental income, further enhancing your financial stability. 3. Hedge funds. Hedge funds are designed by the rich to make the rich even richer, often using unconventional strategies. Unlike regular investors who hope for companies to grow, hedge funds can profit when companies fail, as seen with the GameStop saga. Hedge funds use debt to short stocks. For example, if you expect Facebook stock to decline due to a new privacy policy by Apple, you borrow and sell Facebook stock at $100. If the stock drops to $70, you buy it back, return it to your broker, and pocket the difference. However, this strategy is risky because if the stock price rises, your losses can be unlimited. Short selling is a high-risk, high-reward strategy that hedge funds use to capitalize on declining stock prices. It involves borrowing shares, selling them at the current price, and buying them back at a lower price to return to the lender, pocketing the difference. However, if the stock price rises instead of falling, the short seller must buy back the shares at a higher price, leading to potentially unlimited losses. This strategy requires careful analysis and is typically only used by experienced investors and hedge funds. Hedge funds often employ sophisticated strategies that are not commonly used by average investors. For example, short selling allows hedge funds to profit from a stock's decline. This process involves borrowing shares of a company, selling them at the current market price, and then buying them back at a lower price to return to the lender. The difference between the selling price and the buying price is the profit. However, if the stock price increases instead of decreasing, the hedge fund can face significant losses as they still need to buy back the shares to return to the lender. This strategy is complex and requires a deep understanding of market dynamics and trends. 4. Forex trading. Forex is the market where currencies are traded, enabling international trade. Companies need foreign currencies for various transactions, causing currency values to fluctuate. Forex trading allows leverage, meaning for every dollar you trade, you can borrow an additional $100. Trading with $1,000, you can control $100,000. A small profit of 1% on this amount can yield significant gains. Forex, or foreign exchange trading, involves buying and selling currencies based on market fluctuations. Traders predict which currencies will rise or fall in value based on economic indicators, interest rates, and geopolitical events. Leverage amplifies potential profits, but also increases the risk of significant losses. Successful Forex trading requires a deep understanding of global markets and careful risk management. For example, if a company needs to pay its employees in China, it must convert US dollars into Chinese yuan. The exchange rates between these currencies fluctuate based on various factors, including interest rates set by central banks, economic data, and political events. Forex traders aim to profit from these fluctuations. One of the key features of Forex trading is leverage, which allows traders to control large positions with a relatively small amount of capital. For instance, with $1,000, a trader can control a position worth $100,000. Even a small movement in the exchange rate can result in significant profits or losses. 5. Building a credit score. Debt is a powerful tool when used wisely. Every successful business uses debt, especially with a proven business model. Borrowing money to finance orders is common practice. To get low interest rates, you need to be a reliable borrower. There are billions, if not trillions, of dollars in banks waiting to be borrowed. Even if there isn't money, banks can create it. So stop thinking all debt is bad. High interest debts like credit cards are harmful, but building a good credit score can help you get better rates. Building a good credit score involves demonstrating your ability to manage debt responsibly. This includes making timely payments, keeping credit card balances low, and not taking on more debt than you can handle. A strong credit score allows you to access loans with favorable terms, which can be used to invest in opportunities that generate income and build wealth. It's a fundamental aspect of personal finance and business success. To illustrate, consider that banks and other financial institutions have vast amounts of capital that they are willing to lend. However, to minimize their risk, they prefer lending to individuals and businesses with a proven track record of repaying their debts on time. This is where your credit score comes into play. By consistently making payments on time, keeping your credit utilization low, and not frequently opening new credit accounts, you can build a strong credit score. This opens doors to loans with lower interest rates, better credit terms, and higher credit limits. Essentially, a good credit score can save you thousands of dollars in interest over the life of a loan. If you enjoyed this video, give it a thumbs up and subscribe for more insights on money and investing. Thanks for watching, and I'll see you in the next one.